Welcome back, guys. We're going to talk about Google, but first I want to talk about the overall market, and that's why on my screen is the VIX. That's the volatility index, and this is always on my watch list along with the select number of stocks that I keep on my watch list. It just gives me an idea of overall market, right? There's no need to really track the individual indices. We know the Dow's down, we know the Nasdaq's way down, the Russell 2000's down. That affects me a lot because most of the stocks I own are in the Russell 2000. But the VIX kind of gives me an idea of the overall market. If this goes up, usually the market's going down. That's all you need to know about it, okay? So here's my message on what to do if you're down on individual stocks right now, okay? If you did your due diligence and you researched these stocks and you thought to yourself, these are value investments, these are a good deal at the current price, and you're down, trust yourself. You put all the work into it. You are doing all the proper research. If you're watching this boring valuation videos on YouTube, then you're definitely on the right track. But the one way to go off that track is to second guess yourself and constantly be switching in and out of different positions and, thinking the grass is always greener. And then whenever you leave this one, it goes up, and then you know how it works, all right? We've all done it. Stick to your system, stick to your principles, and you'll do great over the long term. So with all that out the way, let's go to Google. I know up in the top right of my screen, I have the market close value for their Class C shares, GOG, and that's $23.90 per share. But they just announced earnings, and you can see the market, at least in the short term, is not too happy. After hours, we're already down close to 7%, approaching $2,200 a share. And if I look at the 1 month, you can see we're almost at $2,900, and now we're going to be opening up, it looks like tomorrow, closer to $2,200. So just real quick, $2,200 divided by $2,900, you're lost, so that's 76%. So you've lost 24% value in less than a month. So why am I interested in Google? Well, there's really two reasons. First reason is that I did a video on them early on in this channel, and I don't think I did it justice. I think my valuation was kind of all over the place. It wasn't good. So I want to kind of clean that up, tidy that up. And the second is that this is a company that's been on my top watch list for a really long time. What I do is I have like different layers of watch list where, things move up as they get closer to fair value. And then the top is like the ones that I think are great businesses, but I'm just really waiting for the price to kind of get into that last range. Google's finally getting into that zone. And there are a couple reasons why they're at the top of my watch list, okay? The first is that they have amazing financials. I think I really showed that in my other video. This video is going to be more centered around tidying up that valuation. And then the other reason is that I've talked about where I voluntarily spend my money, right? I spend most of my money voluntarily at probably Costco and Amazon, besides bills, gas. I've talked about that before. So Amazon and Costco are two that are on my list, but they're still pretty expensive. Amazon's starting to approach that range where it might be, it might enter my watch list. Costco is so far away from being close to at my watch list that it's still pretty far down, but I really love that company and I think they're amazing, but they're just not close to a fair price in my opinion. And that leaves Google, right? So do I spend any money at Google? Nah, not really. And do I make any money? No, not yet. I mean, I hope that changes, but shoot, it's been zero so far. All right. And then, so what am I talking about? Why are they at the list? Why are they with Amazon and Costco? And the reason is that it is by far the place I voluntarily spend the most of my free time, whether it's making these videos or watching other videos, either for educational purposes or entertainment. I mean, it's both. It's everything on YouTube. And then research, all that's through Google, right? So to think about the percentage of my free time that I spend on that, I think everybody else can think the same thing, right? And the other day I was thinking about it like this. I said, and you can go through this exercise too. What would you pay per month to just have access to YouTube like you have it now for free? All right, what is it actually worth to you? For me, it'd be a pretty ridiculous number because I think I get a lot of value from there. I'd be willing to pay, like I said, a ridiculous amount per month for YouTube just because I think it provides that much value for me. And even though it's a free service that's worth something, it shows that it has value. Now, we're not going to just go out and run and buy a stock just because we like the company a lot or because we think it's a great product. That'd be crazy. We're going to look at the financials, and that's what we're going to do in this video. And I'm going to show you a new wrinkle on how to do valuation at the end. And, I want to say this too. If you're ever confused by the videos, if you ever don't understand something, tell me in the comments because that's my fault if that's the case, okay? It means I'm not explaining it right. All right, so let's go to let's see, what's next on my outline? The earnings release, okay? What did they say that made them drop 6.8% in after hours? All right, so here we are. Alphabet announces first quarter 2022 results. I keep on calling them Google, not Alphabet, who cares? They're Google to me. All right, so look at this statement from the CEO. Look how short it is. It's kind of funny because I'm suspecting it's good news. Usually if somebody's delivering bad news, they'll explain over like 2 pages why, they'll try to use as many words as possible to justify their shortcomings and stuff. But if it's good news, it's like, yeah, well, let me read it first before I say anything. Q1 saw strong growth. Okay, we'll keep investing in great products, services, and create opportunities for partners and local communities around the world. The CFO says we are pleased with revenue growth. We continue to make considered investments in CapEx, R&D, and talent to support long-term value creation for all stakeholders. All right, short and sweet, right? There's nothing negative here at all. I mean, I think Netflix's earnings release was like it opened with some doom and gloom statement like revenue is falling and we don't see when it's coming back or something like that. So this, I mean, I don't see anything in the opening statement that would say, sell down 7% on the stock. All right, so let's see. Let's go through the highlights. And the reason I don't get anything from these highlights, okay? I get everything from the financial statements as far as valuation goes. But what the highlights tell me is what the company thinks is important. And that's why I really like to look at them, because they're focusing in on a few key metrics. They're signaling to you what's important. So that's what you should be looking at, okay? So revenue, obviously, that's important, okay? That's everybody. Revenue change, yeah, that's the same thing as revenue. They track operating income and net income. They also have other expenses here. So, I mean, you can see they're pretty simple. They're revenue, net income. You'll see some companies like Netflix, I think, or Facebook that track some weird metric like, average number of users or something like that. But, this one's pretty standard. So ignore my spiel earlier. All right, so let's see. Let's go to the segments. So here are their segments. They're Google search. That's the big boy. Look at that. That's, $39 billion compared to all this other stuff that's, all in single digit billions. Chump change, right? All right, YouTube ads, almost $7 billion a quarter. Google network, and let's see what else. Yeah, Google services, Google Cloud. I mean, it's all this search, right? They make almost all their money from the search engine. And, I'm kind of surprised YouTube's low. I thought it would have been up there with the search engine, but I guess Google search. I mean, no, that kind of makes sense. I mean, Google's everywhere. I think it's become so pervasive that you don't even realize whenever you're using it. Even on my Safari app on my iPhone, it's using Google, right? Whenever I search something up top. All right, so let's see. Let's go to their operating income. Yeah, look at this. Operating income, look how much Google services is making versus this other stuff, okay? They're not, they're the only ones actually making money. Let's go to stock repurchases. All right, so let's see what this says. On April 20th, so that was just a couple days ago, the board of Alphabet, that's a funny name, authorized the company to repurchase up to an additional $70 billion of Class A and C shares in a manner deemed in the best interest of the company and its stockholders. Okay, this is one of the most refreshing things I've ever read about repurchases. This looks like it was written by Warren Buffett himself. What's terrible is whenever you have companies that commit to repurchasing X number of shares no matter what the price is, or they dedicate X number of dollars to repurchases and they're going to spend that, no matter what. They're saying, look, we're going to spend it in the best interest of the company. Hopefully they say it doesn't even have a timeline or anything like that. Yep. Okay, so taking into account the economic cost and prevailing market conditions, including the relative trading prices and volumes, the repurchases are expected to be executed from time to time. Oh, this is awesome. Subject to general business and market conditions and other investment opportunities. That is exactly how repurchases should be laid out. Okay, I love this. What I hate is whenever you have companies, I just said that, but the other thing I don't like is people who just think repurchases are always good, right? And I see this on other YouTube channels and it kind of bothers me because, there's this, I don't know what you call it, like this line about repurchases that by doing nothing, you own more of the business because they repurchase. So now you own a bigger percentage. But what you really want is, as a stockholder, is for the company to do the best thing with the money they're making. And sometimes the best thing is not repurchasing shares, even though it increases your percentage. If it increases your percentage, but they could have used the money to buy something that was going to make even more money, then it was a lousy decision, okay? And they say that here, and this is what I really like. Subject to, and then they say other investment opportunities, and that's what I really like, okay? That's awesome. All right, that's enough of that. Let's just run through the financials really quick. We're just going to do a quick review of those, and then I'm going to go into valuation, okay? So first up, income statement, and we're not going to look at, I don't think we're even going to look at the cash flow statement here, but let's just see. Total revenue, up. Oh, man, they fell. Maybe that's why people are panic selling, okay? But you'll see it's not really going to make much of a difference to our valuation, okay? One thing I want to point out is that I've already incorporated the Q4 results. I had to manually enter them into Excel, but this includes, not Q4, this includes the most recent ones, the ones they just announced, at the end of the day, Tuesday. Okay, so it includes first quarter 2022. All right, so that's revenue. I'm not going to write that down. I just wanted to show that. Net income, let's see, where is that? Net income, yep, same thing. I mean, This was a huge spike up. I don't know. I wouldn't have expected that to last. You got to have some reversion to the mean, right? So this is still great, but I could see how maybe this could trigger a panic sale if your revenue and your income dropped off like that quarter over quarter. But it's still higher than four. No, it's not higher than 4 quarters ago. So yeah, that might spook some people, but I mean, look where it is compared to like 3 years ago. Compared to, yeah, it's ridiculous. People overreact so much. I mean, it's the quote up top, all right? That's people who panic sell based on a tiny earnings miss. Okay. All right, now let's see what's next. Total equity. Okay, let's go. Total equity is still growing, and this is great. All right, if you're growing total equity, that's like the net worth of the company. Love to see that growing, okay? And then one thing we're going to look at here is return on equity. And I want to point out you do not want to look at return on equity for companies that have high debt because you can get fooled by it. You want to look at return on assets in that case. And usually I always look just at return on assets. But in this case, I'm going to use return on equity, and you'll see why in the valuation section. And I want to capture what I think their return on equity is going to be moving forward, okay? Oh, and if you didn't know, return on equity is net income divided by total equity. So in this case, it'd be net income on a quarterly basis times 4 divided by total equity because, you need to multiply the net income times 4, okay? Because it's a quarter. All right, so I'm going to say, so recently they've been at 26, was the most recent quarter. They were really hovering around 20, between 15 and 20, had this spike up. Let's just say 20% for now, and then I might change it later once we get to the valuation, but we'll say 20%, all right? Awesome. Let's go to valuation. I'm going to show you this new way to look at valuing a company. Okay, so this is going to be similar to our Amazon valuation, but from our Amazon valuation, we built the net present value out from revenue and expected margin. For Google, we're going to build it out of their return on equity, okay? So what do I mean by that? This is the thought exercise we're going to go through, okay? So let's say you owned a business that was making 20% return on equity, okay? And let's say your equity was starting at $100,000, okay? So that meant at that time, and I'm up here in the calculator right now, you were making $20,000 a year, but you kept that equity in, okay? So if you keep it in, you add that to your previous equity. So the next year you'd have $120,000 of equity, right? Because the money you made, you kept in, you either paid down debt or bought more assets, whatever, and it turned into equity. So now you have $120,000 of equity. Now you're going to make 20% on equity again, okay? So now you multiply 120 times 0.2, and that's $24,000, okay? So then the following year, year 3, you're going to have $148,000 of equity, all right? And then if you make 20% on that, now you're going to be making $30,000 a year, okay? That's kind of the exercise we're going to go through. We're going to use return on equity to predict their earnings 5 years from now, okay? So how am I going to do that? Oh, I didn't even write down what their total equity is. Let's see. What was their total equity? I'm going to go get it real fast. And it was right at $250 billion, all right? So let me go back. All right, so current total equity, 250, 9 zeros. 1, 2, 3, 1, 2, 3, 1, 2, 3. Okay. $250 billion. Their return on equity was 20%, we said. All right, and then their equity after 5 years. So that calculation, the one I just did step by step on the calculator, the way you do that is you just do this times 1 plus that return on equity raised to the 5th. That's the way to do that calculation just by formula, okay? So now that's equity after 5 years. So in 2027, we're expecting Google's equity to be $600 billion, okay? Now, what is their net income at that time? Well, if they're continuing to make 20% return on equity, it's going to be 20% of this number, right? So it'll be this number times 20%, all right? And that gives us a net income of $124 billion at that time, okay? Earnings per share at that time would be this net income divided by the number of shares, which we said it's up there in the top is 665 million. So 665 and then 6 zeros. 1, 2, 3, 1, 2, 3. Okay, so they'll be making $187 a share at that time, assuming that these assumptions are the same. And then PE ratio. What PE do we want to use? If a company's growing like that, if they're going to continue to grow at 20%, they're probably going to have a PE somewhere between 15 and 20, but let's just be super conservative. Let's say 15. I mean, that's not super conservative, but let's be conservative and say that they're going to have a PE of 15. That means in 5 years, their stock price is going to be their PE times their earnings per share, that their stock price in 5 years will be $2,800, $2,800, okay? Now, what's our discount rate going to be? I know it says net present value $2,800 right now, but that's just because we haven't added a discount rate yet. We have a discount rate of 0 right now. The discount rate is what you want guaranteed from your investment, okay? Or what your opportunity cost is, what you think you can get from another investment. So let's say that you want a discount rate of 12%. All right, then you should pay $1,600 for the stock right now, okay? Some people say they're okay with a discount rate of 7.5%, in which case you should pay $2,000 for the stock right now. I like to use a discount rate of 15%. So that would be, I'd have to wait for the stock to get to $1,400 a share. I know this seems pretty harsh, okay? And if it seems harsh, that's just because I probably used a low PE and a low return on equity. All right, so watch what happens if these two things change, okay? Keeping my really tough discount rate at 15%, or actually no, I'm gonna go back to what most people use. Most people use what, 12.5? So I'll use 12.5. And I'll change the ROE. Let's see, what have they been doing? Let me go back to the balance sheet again. They have been doing 25 to 30, okay, recently. So I picked 20. That's a big difference, okay? Because you got to remember, this number is being raised to a power. It's being raised to 5. So a slight change here makes a big difference. So watch, I'm going to say, let's say 25%, okay? Let me go back. So if I change the PE to 20 and the ROE to 25%, you can see with the normal discount rate of 12.5%, I know it says 13, but it's really 12.5, I would get a net present value of $3,200 a share right now for the company. So am I buying it? No, not yet. I'm still going to be super picky. I'll probably, let's see, what am I going to want to buy it at? 15. I'll probably want to buy it once it starts getting below 2,000. I'm going to really be watching it like a hawk. And 1,800 would be almost a guaranteed buy for me. Below 1,700 would also maybe be a guarantee, but you never know. There could be better opportunities that present themselves, all right? But I just wanted to show you how to do a valuation like that. I hope you enjoyed it. I hope you learned something. Check out more videos. I hope they're not all the same, that you can learn something different from each one. And yeah, like I said, enjoy. I'll see you next time.